Welcome to this series called Finterpret by Center for Analytical Finance at ISB. I am Prasanna Tantri. I teach finance at ISB. Nishant, he's a senior PhD student at ISB. Yeah, Nishant, tell me what paper we want to talk about.
Hi, Professor.
Yeah.
So today we are going to talk about this paper titled Banking on Deposits, Maturity Transformation Without Interest Rate Risk. This is a recent 2021 paper published in Journal of Finance. It is authored by Drechsler, Savov and Schnabl.
So let me interrupt. Journal of Finance is the topmost journal in finance. There are, and if you know it, that acceptance rate is something like 5%. Researchers from all over the world submit papers, 5 to 6% of the papers. So if you submit 100 papers, you are in Harvard, submit 100 papers, you may have 3 or 4 papers in your lifetime. That's the level of scrutiny that goes in when you publish in Journal of Finance. Go on, Nishant, sorry.
So the basic premise of this paper comes from an important role of banks, that banks are able to borrow short term and lend long term in illiquid assets, and because of this and this role of banks in academic circle is called maturity transformation.
Yeah.
So because of this particular role of banks, there has been the plethora of research as well as some even recent events that it exposes banks to risks, like it could cause bank runs.
Yeah, Diamond and Dipigo won Nobel Prize
Yes.
a couple of years ago. Their
Yes.
whole point is this,
Yes.
right? So
Yes.
because you take short-term deposits, savings deposits, and then you fund a power project, and if people come and ask for money, then you can't sell that power project tomorrow morning.
Right.
That's what you mean, right?
Right.
Yeah.
Yes. And so this paper focuses on one of those risks that banks face, which is called the interest rate risk. So when you borrow short term, lend long term, I will explain it through a very simple example. So suppose there is a bank which has an asset that it funds, which is a 3-year zero coupon bond, and it has a liability of 3 to 4 months.
This problem with PhD students is that even when things, there is no. This is why academic research doesn't reach, right? There is no simple language is not known at all. So let's not use this bond language. And one of the things that we're going to do in this whole thing is that we will compromise on rigor for the sake of understanding. So let's say, instead of saying 3-year zero coupon bond, which would have alienated a lot of our viewers already, let's say 3-year loan. Why don't we say that?
Yes.
So bank has given a 3-year loan.
Yes.
And funded it with a savings bank, a savings deposit.
Savings deposit.
Right. So now what happens if RBI increases interest rate?
So if RBI increases interest rate, now it affects your liability side. On the liability side, you are paying more to your lenders, but on the asset side, because you are lending long term, the income that comes in, that does not increase in the same proportion.
Yeah, so this is, I think, more applicable in the US context. This paper is in the US context, and I have to tell the viewers what happens in the US is most of the loans are fixed interest loans. That means there is no concept of repricing them. Like in India, you are flexible. Every 3 months, 6 months, banks change their interest rates. So once I give you a loan, interest rate is fixed for the tenure. Yes. So in this context, if you have a long-term loan and you're funded by a short-term deposit, so what you're saying is when interest rate changes, you will have to pay more on the deposits, and your income does not change, so you will lose out.
Yes.
That is why banks are supposed to get adversely impacted by an interest rate hike. Does that make
yes.
Did I summarize it correctly?
That is exactly
right.
What should happen.
Sure.
But what this paper shows is that does not happen in the US. If we look at the figure that you can see behind me, if you look, because what should happen if the bank is losing out because of an interest rate hike, what should happen is it should also reflect in the stock prices of the bank. But what we see in the figure behind me is that the response of a bank's stock is no different from any other industry stock in the US. If you take last 30 years of data.
Okay, so this figure is showing that how did each firms in each industry react to an interest rate hike.
Yes.
So when Federal Reserve, which is equivalent of RBI, increased interest rates,
Yes.
how did different sectors react?
Yes.
And based on our conversation before, you expect banks to be most negatively impacted.
Yes.
Because they have lent long term, their liabilities are short term, they have to pay more interest, but they are not going to earn more interest. So their net interest margin will go down, and therefore they should be negatively impacted.
Yes.
And what you're saying is they are not,
Yes.
right?
Yes.
Or they are in somewhere in between. Is that the,
the
where is bank?
The blue bar here shows the bank.
Okay.
And the rest of the bars, and there is pink bar which shows the market.
So they are very close to average
very
reaction.
close to the market.
This is very surprising. This is where the paper starts. This is a very surprising finding, because based on and any analyst discussion, and I'm sure you also spend time in the real world, is interest rate goes up, bank stocks need to be sold.
Yes.
This is telling us that's not true.
Yes.
The banks are doing better than retail, electronics. Look at it. When interest rate goes up, electronic sector does worse than banking, and this is data. This is not theory. This is not theorized. What's going on, Nishant? What is this? Is there some more thing that you want to share?
Yeah, so
surprising stuff.
So now, if we directly look at bank's profit itself,
let's look at it. How is it changed?
So let's
move
go
on.
to the
Let's
next.
move on. Yeah.
So now, if we directly look at the bank's profit, so here in the next graph, the blue line shows the bank's return on asset. So this figure plots the bank's return on asset from 1955 to 2015. The blue line
60 years.
60 years of data. The aggregate ROA of all the banks in the US.
Return on assets.
And the red line shows the aggregate net interest margin.
Net interest margin is the difference between interest they pay and interest they earn.
Yeah.
Interest they earn minus interest they pay.
Yes. And the black line shows the federal funds rate, which is the interest rate set by
like our repo rate.
Like the repo rate set by the central bank in India.
Yes.
And if you look at the contrasting thing in this figure is that Fed's fund rate has ranged from about 0% to going up to 16%.
Paul Volcker's 1980s.
Yes.
Yeah.
But if you look at the net interest margin and the return on assets, which are the profitability measures of the banks, they have remained flat. So almost for 60 years.
Yeah, what you're telling me is 1980 when Fed increased interest rate to 16%. Today it's 5.25, 5.5. Even then, banks which had short-term liabilities and long-term assets on which interest rate was fixed, because they would have lent before this, maybe at 4, 5, 6, 7, 8%. They did not lose money.
Yes.
Even when the interest rate went up to 16%, because they have to reprice their liabilities immediately. Asset repricing is going to take a lot of time. So they must have lost money. I hope it is clear to everyone, and those of you not clear can write to us as to what is the anomaly we are talking about.
Yes.
And this is data, right? This is not constructed or anything.
No.
This is data. Anyone can replicate.
Yes. Anyone can replicate this data using this data.
Right. And this is a published paper, so code and data are available.
Yes.
Go on. Right. So the bottom line is, even when Fed funds rate fluctuates widely, bank profits are not changing. Whether you look from return on assets, whether you look net interest margin, profits are not changing. So it is not true that banks are more impacted by interest rate hikes.
Yes.
Are we not saying something very, very contradictory and controversial?
Yes.
Right?
Yes.
People may think what nonsense you're talking.
Yes.
Banks are not impacted by interest rates, right? But that's what the data shows.
Yes.
But is this only US or does this happen
in
in India?
In fact, if you look at the next figure that we have,
what is this?
So this figure is similar to the previous figure. Here, the only difference is that we only plot one measure of the profitability of the banks, which is the net interest margin, which shows as blue line in this graph, and the green line shows the repo rate, which is set by the interest rate that is set by the central bank. And if you look again for India, the repo rate has ranged from 4% to about 9%, which was in 2001.
Right.
But the net interest margin has been again flat for the last exactly the same thing that
same
pattern
happening in the US. This is fabulous, right? So economics and finances, people say it is not scientific and all that. I agree, it's not as replicable as the physical science. But look at this. This paper is showing something for US, and this you did.
Yes.
I didn't do so. Most of the work is done by PhD students. So people like us just talk, and let's trust that what you've done is correct. So you're finding same thing in India.
Yes.
So interest rates have changed 9%, 6%. During COVID, it came to 4% repo rate, and this is COVID, right?
Yes.
And net interest margin profitability of bank has not changed at all.
Yes.
I'm sure if you put in return on assets, you will get similar kind of figures.
Yes.
So that means this phenomenon is happening in India also.
And you seem to suggest that there is some hidden asset that banks have. And can you explain that with a simple example?
Yes.
I know for a IIM type it's very difficult to be simple, but try to be as simple as possible. Otherwise,
Yes.
I am their viewers to simplify.
No.
Yes, let's move on.
No, I'll try to be very simple with this. So particular balance sheet is itself a very simplistic representation of the actual balance sheet of a bank. Here we have on the asset side we have long-term assets and short-term assets, and by long-term assets we mean the long-term loans that banks are extending. These are fixed rate loans which do not reset at regular frequency. So you can think about it, loans are
Some mortgage, 30-year mortgage.
30-year mortgage loans which are not which are completely fixed rate for the entire period of the 30 years. And then there are short-term assets like investments in short-term bonds or investments in or some kind of floating rate loans which keeps resetting in 3 to 4 months.
Sure.
On the liability side, on the other hand, here we have a savings deposit. Here we are assuming the equity capital to be zero. These are very simple assumptions that we make generally in academia to just express that point, make the point about.
Yeah, we'll come to that. We'll
what
discuss
way, and we will discuss it in more detail later. So now, what should happen with this particular balance sheet? How should 1% increase in central bank's interest rate affect this particular balance sheet of
I think I have a suggestion to viewers. Why don't you pause this for a minute and just think about it? What will happen? Of course, we are going to continue. You pause, right?
Yes.
1% and let me try. You are IIM and I'm not.
Yes.
I'm BCom. So let me, whether I can understand, let me make an attempt. So this tells me that if Federal Reserve increases interest rate by 1%, so because liabilities you said will be reset quickly, the deposits. So banks' expense should increase by 1 rupee because they have a 100 rupee deposit, but their income will go up only by 75 paise.
Yes.
Why? Because that 25 rupees that they have lent on long term, by contract they can't increase interest rates.
Yes.
So they are going to lose 25 paise.
Yes.
But your figure shows their income does not change when interest rate goes up,
Yes.
right? This is the whole puzzle in another way.
Yes.
So now can you explain why does this happen?
So now banks have this have this power called deposit franchise.
Okay.
So what happens is banks do not. So for a 1% change in interest or increase in interest rate, the banks will not change the deposit rate by exactly that 1%.
They are going to change less.
They are going to change it less because of that power that the bank has.
And that's the discovery of this paper.
Yes.
So the central discovery of this paper, like in natural sciences, even in economics, finance, papers discover something. The discovery of this paper is that there is an asset called deposit franchise which banks have, which is not shown in balance sheet, which gives them this power of not increasing interest rates on deposits when the market interest rate goes up.
Yes.
Right?
Yes.
The increase is not 1-to-1.
Yes.
When central bank increases interest rate by 1%, banks increase by less.
Yes.
So let's say, so can you illustrate in this case what can happen?
So let us look at situation 2. Again, this is a very specialized hypothetical example for understanding. So let us say for a 1% increase in interest rate, now the banks are only transmitting 75% of that increase to their to the depositor.
So this electrical engineering thing will never stop, right? So if when banks, you're saying, suppose banks have the power that when there is interest rate goes up by 1 rupee, 1%, they'll increase interest rate only by 3/4%.
Yes.
Right?
Yes.
So in that case, what will happen in this balance sheet? Again, let me make an attempt.
Yes.
Right? So because now your 100 rupee deposit, central bank increases interest rate by 1%, your cost will not increase by 1 rupee now. Because you have this power.
It will only
70%. So what do you mean, viewers, by this power? Power means even if I don't give this depositor what is available out there in the market, because they can go out and get this 1% extra, they will not leave me.
Yes.
This is the power that I have as a banker for some reason.
Yes.
Where it comes from, we will see.
Yes.
So I can get away by not increasing interest rate as much.
Yes.
So in this case, I increase interest rate only by 75 paisa.
Yes.
Not 1 rupee.
Yes.
On the asset side, anyway, I am getting 75 paisa.
75 paisa.
So I am hedged.
You're hedged, completely
so,
hedged.
So I'm
Yes.
not losing any money.
Yes.
So it's
Yes.
not a surprise.
Yes.
So
Yes.
this deposit franchise lets me do this.
Yes.
This is the
Yes.
magic you are showing. So,
Yes.
so this figure is showing the same thing.
Yes, this figure is the exact thing that this paper is about.
Right.
This is the contrasting thing that this and any paper in finance and economics, they have this story, one single story to sell,
Sure.
and this is the story that this paper is selling. That under situation 1, which is the conventional, more talked about situation, more and commonly viewed situation, as the interest rate increases, the bank's profitability or the net interest income of the bank should decrease.
Yes.
But we have demonstrated in under situation 2 that it remains flat, and that's what this paper is
So
talking
that
about.
means if the banks have even more power,
Yes.
let's say you give a hypothetical example of passing on just 3/4, right?
Yes.
What if they can get away by passing on only half the interest increase? Can you, do you have an illustration?
Yes, we do
Yeah.
have an illustration.
So it's a
for
prepared
that.
one. We are pretending as if you're coming out
Yes,
with
yes.
on the fly. That's okay.
Yeah.
People will understand that. Let's move on. Yeah.
So now again, very specialized example. Now we are saying that for a 1% increase in interest rate, the deposit rate the interest expense increases by only 50 paisa.
Because bank has even more power.
Yeah,
So this
bank has even
depositor
more
is
power.
not going to leave even if I just give that person half of what
Yes.
additional interest rate
Yes,
that has
yes,
happened.
yes.
So what it will allow the bank to do?
So now if you want to fully hedge that 50 paisa increase in the deposit or in the interest expense on your liability, you can have you can increase your long term asset from 25 to 50 here, because with a total asset of 100 and of that 50 rupees in long term asset, if the interest rate increases by 1%, your interest income will now also increase by 50
This
50
seems a
paisa.
bit complicated.
Yes.
What you mean by hedge is that if you want to be totally insulated
Yes.
from interest rate shocks, now you can have 50 rupees of long term loans instead of 25. Why is that? Because when 1% interest rate goes up by 1%, your interest cost is only going to increase by 50 paisa.
50 paisa.
Like,
Yes.
because on 100 rupee you are not going to increase 1 rupee.
Yes, yes.
So therefore you can commit to invest 50 rupees in long term assets or power projects or whatever lend, because where you don't change interest rate regularly.
Yes.
And 50 you only need to keep 50 in short term.
Yes.
Now what's the advantage to the bank? Why should I can understand advantage to the society, right? You can have investments, jobs if you have long term assets. What will bank gain by this?
So generally what happens is, on a long term asset you can charge a higher interest
Okay,
rate
yeah,
compared to a short term
Sure.
short-term
Annualized
loan.
interest rate.
Yes.
It's
So-
not always true. Sometimes the other way around we
Yes,
can discuss, but
yes.
mostly it's called term premium.
Yes.
So long term interest rates are higher, and
Yes.
banks make money.
Yes.
So the point is banks are naturally hedged.
Yes.
All of this drama around asset liability management, most of it may not be required as much because banks have this deposit franchise, which is an asset, which gives them this power not to sort of withhold some of the interest rate increases, right?
Yes.
This is what you're trying to say.
Yes, yes.
Now the question is, where do they get this power from? And this is all imagination of some academicians, or people in the real world also talk this language.
Yes.
May not be these words.
Yes. Yes.
Because you made all those crazy assumptions, no capital and all, people are already upset with you. What are you talking
Yes.
about? This may not work in real world, right?
Yeah.
So let's
Yeah.
come to the real world. Tell us, where is this coming from, and some real world way, people have, whether they recognize this.
So just like any other company, even banks to build this power, they have to make some fixed cost. They have to spend something.
Right.
So for example, they also spend, just like any product company, they also spend in marketing to extend their reach to the customers, to give more convenience to the customers, so that the depositors come to them.
Right.
And even if they are not changing the rates on the deposit in proportion to the change in the interest rate, the depositors stay with them because of that convenience or that reach that the bank has given or provided to those depositors.
Sure.
So it is through those
So this
investments
is
that-
this marketing and all kinds of expenditure that they do that gives them this
Yes,
power,
yes.
branch and
Yes,
all
yes.
of that
Yes.
that do. So so that means these are not expenditures. So in accounting we consider all of this as expense.
Yes.
So you are saying this is an investment bank does.
Yes.
And because of, and that creates this asset.
Yes.
And because of which there, banks that spend a lot of on building branches, make these nice branches.
Yes.
I remember when I grew up, private banks started coming. They had AC.
Yes.
Sometimes we used to go to ATMs just for AC sake.
Yes.
And then they recognized and they draw us away from the ATMs.
Yes.
That's what we used to do. But these are not just. This is giving them a power that the depositor will not leave you even if you don't pass on the full benefit.
Right.
That is this asset this paper is
Yes.
talking. Do the people in the real world recognize this in India?
Yes. In fact, we have an excerpt from the IDFC conference call, which is the closest you can get to the real world, right?
Yes, yes.
It
is the real world. What do you mean by
it is the
closest?
real world. Yeah. It is.
Yeah.
So as you can see this from this statement. So let me just say that one defining factor for the last 5 years has been deposit growth period, and all of us know that deposits practically are the foundation of any bank, and this kind of deposit growth has come despite the fact that along the way we dropped interest rates. Most people thought that we stay with a 6%, 7% strategy for a long time, but literally within 3 years we dropped it, and now we pay 0 to rupees 1 lakh. We just paid just 3%, and still last quarter we saw a deposit growth by 43% year on year.
So it's not. So look at this. When they were not known, this is IDFC. Maybe the CEO speaking. I don't know.
Yes.
Whoever is speaking
Yes.
in the conference
Yes.
call.
Yes.
Initially, IDFC Bank was not well known. This deposit franchise asset was not there.
Yes.
So that time they had to pay something like 7%.
Yes.
Now he's saying it's like fixed 3%.
Yes.
And RBI has increased, as you know, in the last 3 years. Repo rate has gone from 4% to 6.5%. Despite that, they are getting away with 3% savings rate, and that means this is happening in the real world.
Yes.
So it is not some fiction of imagination of some academician sitting in the US,
Yes.
right? So this is giving an explanation why this is happening, right? So
Right.
now, so the balance sheet therefore should appear something like this, right? In reality, you should recognize this asset.
So readers would remember this particular balance sheet from our previous 2 videos.
Yes.
Here we have long-term assets, which are long-term loans that banks extend, and short-term loans on the asset side.
Yeah.
And on the liability side, we have savings deposit, and equity capital is assumed to be 0. And we have discussed why we do that in the previous episode. So now let us say for this particular balance sheet where there are only short-term loans.
Yeah, in the previous episode there was long-term loan and short-term loan. Now you are saying in this example, let's assume there is a bank which has short-term deposits and short-term
loans.
So conventionally they don't have interest.
They don't have interest rate risk.
Right. You are saying they are risky.
Yes,
now you have to prove that they are risky.
So
you are under pressure.
Yes.
Yeah.
Yes. So far we have talked about interest rate increase.
Yes.
What we are going to discuss here is that interest rate decrease is a problem. Is a sort of problem here.
Right.
So let us understand it with a very simple example.
Sure.
So let us say that the interest rate that the banks can earn on their short-term loans in this particular balance sheet example is say 6%.
Okay.
And the what they have to pay to the depositors, the rate they have to pay to the depositors, the savings on savings deposit is say 4%.
Okay.
So now what will be the interest income on these loans?
6 rupees.
6 rupees.
Yes.
Similarly, interest expense is also very easy to get.
4
it's rupees 4.
Yeah.
So now the gross profit on this particular bank is rupees 2,
right,
which is the interest
before considering
income
expense.
minus
Sure,
interest
sure,
expense. Now let us say you already talked about the kind of fixed cost that these banks have to invest in order to develop
deposit franchise. Yeah.
Deposit franchise. So this bank is assumed to have that deposit franchise.
Sure.
And the value of the deposit franchise, which we represented by beta in the previous episodes,
despite
is
my best
0.5,
effort, you had to bring in that
yes.
term. Okay.
Yes.
Otherwise, khana hazam nahi hota. You don't talk about beta and all of that. Okay, fair enough. I can grant you that much.
So now let us assume that operating cost that the banks spends on developing that deposit franchise is rupees 1.75. So now the net profit of the bank is simply
25
rupees 2.
So those of you who have missed these numbers, just pause for a while, and it's very clear. There is a bank which is earning 6 rupees of interest income, 4 rupees of interest expense, 2 rupees its gross profit.
Yes.
It incurs 1.75 on AC, advertisement and all that. So net profit is 25 paise. This is what you're saying?
Yes.
All good.
Yes.
Okay.
Yes.
So
all
now what
good
happens if interest rate goes down?
Now suppose the interest rate falls by 1%.
So okay.
both interest income and interest expense of the banks will be affected.
Yes.
So now interest income, because these are all short-term loans, will go down by ₹1 because interest rate has fallen by 1%.
Sure.
So now the interest income becomes ₹5.
Right.
Interest expense on the other hand, because this bank has a deposit franchise,
Right.
the interest expense only goes down by 50 paise.
If that's what you are saying, beta is half.
That is
so.
that
The point you are making is the depositor starts seeing this savings deposit as some kind of a fixed interest asset.
Yes.
Right. For the depositor, it's an asset.
Yes.
So you can't reduce interest rates. You can't reduce also for a lot of deposits.
Yes.
While it's going up, you banks had fun. While going down also, they can't reduce by 1%.
Yes.
So they can only reduce by part of it.
Yes.
So their interest expense will fall only by half. Because assuming that's an assumption we have made.
Yes.
It could be anything. So expense falls by half. Income falls by 1.
So
gross profit falls by 50 paise. So already profit was 25 paise. They are wiped out.
Yes.
25 paise is gone.
Yes.
Plus, do they have to keep incurring this expenditure? Well, there's 1.7.
Yes. So that 1.75 does not change because that is
fixed expense.
Fixed expense.
Yeah,
so
you can't say I will not give you coffee now. I'll switch off AC. In summer, and then you will lose all loans also.
Yes.
No, that's not possible. That's what it is. So interest rates go. So having a perfectly matched balance sheet is a risk.
Is a risk.
Okay, I'm going to use this in my class.
Yes.
Okay, maybe we should delete this video so that I can share it in class.
Yes.
Right? This is very interesting. That's what this paper shows.
Yes.
And trust me, a lot of regulators, people who write books in your, they are not aware of it. This is a 2021 paper, and people act as if this does not exist.
Yes.
Right? This is very interesting.
Yes.
And have people started looking at its implications on India? So, let me, I think Indian situation is slightly different, as you know.
Yes.
Because although banks lend for a long period of time, interest rates keep changing.
Yes.
It's flexible interest rates.
Correct.
Right? And deposits anyway are flexible.
Yes.
Right? So, Indian implications are very different. People have started doing some research, right?
Yes,
There is
a paper by Kulkarni and Singh, Nirupa Kulkarni. She is from CAFRAL. So she is working on a paper with a co-author that uses Indian banks' status, extent of deposit.
And what's the main claim of the paper?
So main claim of the paper is that the infrastructure boom that happened in 2000s was because of the deposit franchise that banks have.
So the infrastructure lending and which led to a crisis, this deposit franchise had a direct relation to it, right? So I don't think we have time to get into the details of the paper. It's still a working paper, and knowing them, these authors, they will surely publish in a good journal. Once it's published, let's try to have them here and discuss this paper. But then look at the implication. This has led to a big crisis in India. That's what the paper shows, and why and how we can discuss later. Right? So now coming to, we have promised our viewers that there are non-academic implications, non-policy implications as well, right? That is what we promised our viewers. So, is there some trading strategy that we can think of? Be careful. Our producer is going to put all that line that we are not responsible for your losses. We are not trying to do it tomorrow morning, but at least a way to think about it. Is there something that we can think about here?
Yes. So now there are banks with deposit franchise So now again, the viewers can go back and do this exercise. So basically the point is that there are banks with deposit franchise, there are banks with less of it.
Right. How do you determine that? Maybe you can see how their deposit interest rates change when there is a change in central bank interest rates. The banks which have to change deposit rates close to 1-to-1 have less deposit franchise. Banks that can get away with less change when the interest rate goes up, they have more deposit. Is that what you're saying? Now I identify these two banks. So what will I do?
So now if you expect the interest rate to go up,
right?
Say interest rate increases by 1%,
right?
So now what will happen is banks with deposit franchise, they are banks with so if and suppose in Indian situation, suppose there is the asset liability mismatch, say, is low. Or assets or banks.
So let's ignore the asset side. Let's say all banks have similar asset structure, which is loan structure. Now, given everything else same, there is a bank with high deposit franchise. There is a bank with low deposit franchise, right? If interest rates were to go up, now which bank will suffer more? the bank with low deposit franchise,
will
right?
suffer.
Because they have to pass on the interest rate to the depositors.
Yes.
So bank with high deposit franchise is unlikely to suffer. So now you have a trading strategy. You can go sell this bank and buy this bank, right? And it's reverse when interest rate goes down.
Reverse when interest rate
The bank with high deposit. So something like private bank versus public bank, can we think about? Public banks may have higher deposit franchise, private banks may be having a lower deposit franchise, possibly. You can at least try this on the data, but at least giving you some ideas, fresh ideas from where people can experiment. And that's the other use of this paper, right? So to summarize, as I said in the first episode itself, the entire paper is written without any prediction. Economists, serious economists, are not sitting there and thinking about what will happen next quarter or the growth rate is going to be 7. That's not papers are about. Papers are about identifying a phenomena, explaining a phenomena, and thinking about implications. We are working on a paper. We'll discuss. This will lead to a lot of research. As I already said, Indian infrastructure crisis could be explained using this. This will give us valuable lessons for future. This is what I said right at the beginning, and this is an example of how papers are written and how it is useful. Right now, what if I directly get into why do we need intermediaries like us? Right? Can you show how what does the paper say? So just see the abstract at least.
So I'll just read out the abstract for the readers to decide for themselves what would have happened if they have straight away
read the paper.
Read the abstract of this paper. We show that maturity transformation does not expose banks to interest rate risk; it hedges it. The reason is the deposit franchise, which allows banks to pay deposit rates that are low and insensitive to market interest rate.
I think people have already switched off, right? So no fault of the authors. They are great scholars, but academic papers are written like that. They are for a scholarly audience, and it's assumed lot of knowledge is assumed. For example, it's assumed that people know what is maturity transformation. It's people will. So that is why that's an attempt that we are trying to make. We are trying to simplify this because it's useful. This is, although it is written for academic audience, it's useful for policy, it's useful for real world, it's useful for just to increase understanding of banking. So that's the whole attempt that we are trying to do with this whole exercise. And we are going to continue this. And Nishant will be let go, and we will have our producer is already looking for the next PhD student for the next episode. So we are going to discuss policy issue next time. This time it was banking, and let's talk about implications of health insurance maybe. And we are going to come back soon. And we are also going to put all these 3 episodes together into one episode. And the utility of this, unlike this is not a hot topic that we are discussing. The problem with hot topics that you see in a lot of places is that after 15 days it's not very useful. For example, if I did a show or participated in a show on farmer agitation and agricultural reforms and all that, and then they pulled it out, they never showed it because they said it's now not relevant. This is not like that. Electoral bonds, if you have a discussion now, it's not relevant after 15 days. There may not be any electoral bonds. This is not like that. This is going to be relevant 5 years from now. We are going to talk papers written in 1970s. I'm not saying this is correct. The thing about science is falsifiable. It's with data, you can check, you can test, verify and falsify. That's what science is, right? So that's the beauty of these academic papers. I hope you like this discussion on one paper, and we are going to bring more such papers and highlight their relevance. We are going to simplify, explain and highlight their relevance. Thanks a lot. Thanks for your feedback, and this is not the end of the show. We are going to have more such episodes, the end of this paper.